Welcome back. As promised, we have the management of Samvardhana Motherson with us. Very strong numbers by the company. Over 42% rise in EBITDA, 20% improvement in revenues. We are joined by the Chief Operating Officer, Pankaj Mittal, and the Chief Financial Officer, Kunal Malani, who is with us. So, gentlemen, morning to both of you. Mr. Mittal, I want to start with you. You know, overall in FY24, right, the year has ended and the consolidated revenue growth has been 25%. Can you tell us what is the outlook for FY25? Can you do this kind of growth? Can you do better? And what are the demand trends looking like now?
Well, if we look into the basics, you will see that we have been growing both organically as well as inorganically. So this year, both the organic growth and the inorganic growth contributed nearly a similar amount, 12.5% coming from organic growth, 12.5% coming from inorganic side. And moving forward also, we are on a very good path, setting up 18 Greenfield sites, which will come into operations. We have the acquisitions which have been closed, which are not in the P&L this year, like Yachiyo. We have done ADI, Lumen, all put together. They will contribute, if we look on a full year basis, all the acquisitions which we have done, they should contribute another 14,500 crores or something like that in FY25. So organic, inorganic, and we are on a very good way towards our Vision 25, which has been for $36 billion. So more things to come in. We see a good future being a powertrain agnostic company. So we don't get so much impacted with the changes which are happening in the market. We supply to all kinds of vehicles.
Okay. So you're saying that the acquisitions will contribute 14,500 crores in FY25. What would that be in terms of growth? What are you looking at? And what will the organic growth be in FY25?
Well, being an OEM supplier, we can't exactly put a number to that. But as I mentioned, that the basics are in place. We are a deleveraged company with very good ratings. So, being acquisitive in nature, customers give us many more opportunity. And that's why we look at acquisitions to also grow. And the companies which we have acquired, they also have very good future in terms of their organic growth. Because when you look into the market, like Yachiyo coming into the fold, both their main products like the sunroofs as well as plastic fuel tanks, they would see a very good growth. We have very good technologies which came into the fold in terms of our interiors, exteriors. Vehicles are getting premierized, and that holds very good in terms of providing solutions to our customer. And most of these greenfield sites have also come in the emerging markets, most of them in India and China, which are high growth markets.
So just a couple of questions. You said $36 billion continues to be your revenue target for FY25, correct?
That's the 5-year vision which we had set for ourselves. So that's a visionary target which we set, and we always move towards that without, just driving towards the top line. So always you would find Motherson keeping a very good balance in terms of how we can be value enriching to all the stakeholders and do the acquisitions at the behest of the customers, where we have the blessings that it gives global solutions to them.
Got it. You were talking about Yachiyo. Just to follow up there before we head to Kunal. I mean, you have sort of this acquisition has helped you get into different spaces, right? Whether it's sunroofs, fuel tanks, resin products, etc. Are you looking to expand your product portfolio further? And in the on the acquisition side, where would your sights be set now?
Of course, we are always wanting to do something which our customers want us to do. So that's how the whole product portfolio has expanded. And we would not hesitate to do more wherever the customers would want us to get into. Also, you would see that our emerging businesses, they are doing very well. This year, they contributed more than 8,000 crores of revenue. And that's another area. So aerospace, the health vertical, lighting and electronics, all those areas are also growing at a very healthy pace. And we see a good growth in those divisions as well in the coming years.
Just want to sort of also talk about the cost factors. Kunal, if we could sort of come to you. Margins have expanded in Q4, and that's great. But how sustainable is that expansion, given the rise that we're seeing in a lot of material costs, particularly metals? What do you envisage going ahead? And what's a steady state margin that you would hope to maintain for the year as a whole, FY25?
Okay. I think, firstly, as we have always said, please look at Motherson on a longer term basis. A quarter is not necessarily reflective of much. So if you look at an annualized level, yes, we have improved our performance. And we've always said, please look at the absolute numbers. And on an absolute number, we will continue to growing going forward as well. The number to really focus on is RoCE, which we have expanded from 11% last year to 18% this year, if you were to exclude some of the M&As and greenfields that we have set up. If you include them, we are still at 17 odd percent. And here we see a lot of traction in being able to further grow this in 25 as well. I think Pankaj mentioned some of the acquisitions which are yet to be embedded into the P&L side. They are already in the balance sheet side, but the P&L, the full impact is not there, and hence the 14,500 crores is the minimum that is going to come on the top line side. Other than that, I think the business performance has done reasonably well. The outlook seems decent, and hence we've been able to also recognize deferred tax assets of some of our past losses in this quarter. And that is again reflective of a longer term change that's occurring where many of our units which had challenges in the past, I think a number of the teams done well to kind of improve the performance on a fairly consistent basis. And that's what's driven our ability to then recognize some of these deferred tax assets. So I think all the ingredients are there that we should be able to further propel from here on RoCE. Our target is 40%, so still a long way to go in that regard. But I think directionally we should certainly be able to improve this very well in 25.
Okay. Just a word also on the capex and debt levels and how you're looking at sort of that management. I think the capex plan for this year is 5,000 crores. In the previous quarter, you also pared down some debt. So what's the guidance that you can provide in terms of the debt levels that you'll hope to maintain, the debt to equity, and just maybe a little more color on the 5,000 crores of capex? How will you put it to use?
So out of the 5,000 crores, we've announced 18 new greenfields, 6 of them in this quarter, 12 we had already announced in the previous quarter. So on these greenfields, around about 2,000 crores is what is going to get spent. The remaining is the normal maintenance capex that occurs, or program capex that occurs. So we're looking at something like 5,000 crores plus minus 10 odd percent is what we are aiming for, at least in FY25. With this capex, together with some of the cash flow generations, improved performance of the business and so on, I think we will still be on a deleveraging path. So from a debt perspective, if we do not consider any incremental inorganic growth that we do, in our view, the leverage ratios or debt to EBITDA should be somewhere in the 1x odd levels, give or take, by FY25. So overall, I think there are again many levers of cash flow generation with some big, greater degree of stabilization coming on the working capital side. Stuff like commodities, etc., to us is a pass-through. Yes, they have gone up, but from a lag perspective, they become pass-through. So overall, I think again all the ingredients are there that we should be able to deliver from here on an organic basis, in spite of all the higher capital that we are doing for growth.
Okay, so you said debt to EBITDA should be in the range of 1x, right? Your net debt is now at 10,300 crores. That's a drop of almost 18% quarter on quarter. What do you expect the net debt to be by the end of the next year?
As I said, we don't want to hazard a guess on this. As I said, it is 1x, so it becomes very easy to look at what it is likely to be. But I would just say that it's a direction where, in spite of all the incremental capexes, in spite of, inorganic growth opportunity, the sector that we're looking at, our leverage ratio remains fairly, good and has the necessary, let's say, the firepower now to go after the incremental growth that we are looking at in FY25. The direction on 1x is to highlight the fact that there is a lot of headroom, and for sure we are inundated with a fair amount of M&As, and hence it is, and that's the reason why I don't want to give necessarily a number out, because inorganic growth will still be part of the puzzle as we move into FY25.
Okay. So, the strongest growth, Mr. Mittal, I want to come to you on that. The strongest growth has been in the emerging businesses, and it's interesting there, not just revenue growth, which has been about 18%, but EBITDA growth. The operational performance has picked up a lot in the emerging businesses. I want to understand 7% of your revenues comes now from emerging businesses, both auto and non-auto. How much can you grow that to, and is there scope to grow margins further in that space?
Oh, of course. I mean, these are emerging businesses and they are poised to grow at a much faster pace as we move forward. As you know, we have also announced the acquisition of ADI, which is into the aerospace side. So we do see very good traction from our customers for these emerging businesses, and you will see that the next 5-year plan will also see a huge growth coming from these.
Okay, got it. So when you say huge growth, how much can you take it up to? I mean, can it contribute 10%, 15% of your business?
No, I mean, it'll be much faster in years to come
Okay.
because these were the new businesses which were embedded. So obviously, when they are smaller and then they grow, they will definitely grow at a good pace.
Okay. And, I wanted to know on EVs as well, right? That's been the mega trend where the share of hybrid, share of EVs has gone up in the portfolio, not just for you, but for the entire industry. 23% of your automotive booked business is from electric vehicles now. How much can you take that up to, and will that help you further with your operational performance? Kunal, I want you to come in on this.
Look, I think on an EV front and on hybrid front, we've been so number one, I think we are powertrain agnostic. So irrespective of whatever powertrain sells, from our perspective, it works well. Obviously, in an EV or hybrid, the content increase is much higher, and hence it is helpful to see the transition happen. Having said so, I think from an EV perspective, while the growth continues, the pace of growth clearly has ebbed lower. And hence the share of revenues that were being expected from EVs, I think that share hasn't happened as much as what the expectation was. But from our perspective, ICE hybrids continue to sell, and hence it really does not matter from an aggregate perspective. Hybrids, on the other hand, in our view, seems to be catching a lot more fire now, and hence, we expect that share to move in many parts of the world as an intermediate point between becoming completely zero emission from an ICE engine construct. So overall, I think all three is likely to do well, at least in the shorter term. And then I guess we need to see how the technologies evolve to see what other opportunities exist. But again, just want to highlight we are powertrain agnostic, so really does not matter in the aggregate scheme. And the other piece I think which is worth noting is clearly the premiumization on the developing part of the world continues to be much higher. Places like India, China, I think continues to rocket higher on the premiumization front on SUV usage and so on. And that again carries a lot of content increase for us. So overall, our portfolio and geographic mix should be able to propel the growth from here on as well.
Okay, all right. We will leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV 18.